So we are back again with Helen Amadi from Vital Capacity. Helen has over 30 years experience in finance and HR. So today we're going to talk about financing options. So maybe we can start by you telling us, so what options do we have as a business in terms of getting funding?
Okay. So let's start with the proverbial family. Yeah, so a lot of times we find, before we look at other financing options, when businesses are starting up, a lot of them, we are finding them being financed by family members. And usually this is a safe place to start because there's no interest, you know, it's your rich cousin and he has a lot of money and he doesn't worry about when this repayment is going to be done. So that's one of the first options that people have usually when they're starting businesses for startups. But for the rest of us who don't have rich cousins, there are other financing options, and we're going to look at them in two ways. One is the types of financing that you can get out there. So one is debt financing. Everyone knows debt financing because everyone has had to get a debt, I'm sure. If you're a business and you're running a business, you go to a bank, a financial institution, you sign an agreement, they give you the money, and then you pay it back. So that's debt financing, and what do you give them back? You give them interest. And they charge you interest, you pay them back in the way that they should be paid back, you pay back the loan, and you're done. So that's debt financing. So the second type of financing is equity financing, and this is where a business gets the money from the financing organization, and then of course it gives shareholding in return. That means the financier owns a part of the business. Like for example, you get a chunk of cash, and that chunk of cash you're exchanging for 10% of the ownership of the business. So they become owners of the business. So they're involved when it comes to making decisions, and it's a little bit different from debt because these are actually owners, and at the end of the day, you must pay them a part of the profit. So the net profit the business makes, you must divide it in such a way that they receive some part of that net profit.
Okay. So how do you select, and maybe let's focus a bit, because in terms of debt financing, I'm sure it's dependent on what is available. But how do you select an investor? How do you decide that this is the kind of investor I want?
So there are different type of investors. Of course, you know that there are individuals out there like angel investors, and there are other types of investors like accelerators and people like that. Angel investors are usually sometimes individuals who are high net worth individuals. They want to, in many cases, help, but there is also they want to make money off new businesses or established businesses. So they come with their cash. They invest in the business, you pay them back in terms of some interest or a part of the profit depending on the agreement. So, and also other types like accelerators, who this type of people, they come with usually companies, they come with advisory, or they help you set up systems, or they help you in guiding you. They add more value than just the cash that they're bringing to the business. So how do you select this kind of investors? It depends on, first of all, how much cash are you looking for. It depends on how much you want to pay in terms of interest. It depends on who you have access to, because you may not have access to all these kind of investors. And also even financiers, like for example, if you have a bank near you and you're able to access financing from that bank, then of course debt financing is from the bank might be easier for you if you're able to show that you're making a profit to the bank and that you're able to sustain this kind of payments. Yeah, so you usually select them based on who you are as a business and what your needs are. So if you have two businesses, obviously they may not select the same financier because their needs are different.
Okay. Yeah. And what do investors look for, and what are the things that they look for prior to giving you the money?
So investors look for stability. They look for bottom line. They are not angels, of course, even if they're called angel investors. They are looking to make money. So they want to see your business plan. Are you able to make money or are you not? They look at your history. How have you performed in the last 3-5 years? Have you been making money up to now? Who is your auditor? Are they able to produce audited accounts that talk about profit and the fact that you're doing well as a business already before they put their money in, because they don't want their money to come in and then gets lost in there. And is it an ongoing concern? Are you likely to continue going on, or are you about to close down? Yeah, so those are the things they look for. They also look at, for example, who the other financiers are. Do you have a lot of debt out already? Are you paying out a lot of interest? They wouldn't want to touch you in such a case. They want to see that the money that you're making, obviously, they're going to benefit from it, not that it will be used to pay other people who you owe money to. Yes.
Okay. And when now choosing the investor and when we're signing a contract for equity, what are the clauses you want to look out for that might not be good for you as a business?
Yes, yeah. If you have a lawyer, this is a good place to start, or an accountant who can be able to look at your agreements. So a lot of these investors usually put clauses in when it comes to repayment. Like, for example, when they're structuring the loan or structuring their financing, they make it more beneficial to them when it comes to, for example, you've missed a payment, default. There are charges they're going to bring in there. There'll be interest, penalties, things like that. You have to look out and see whether there are penalties that are built into those clauses. Because if they are, then they're going to punish you. You also have to look at how the payment, let's call it the payment patterns are. Are you paying back every month? If you're paying back every month, does your business make money, that kind of money, every month or not? Because, for example, you're in a business where you make money actually maybe twice a year during school holidays, for example. You are not going to structure that loan in a way that you have to pay back money every month. You have to make it such a way that you pay back quarterly. So if you're in the farming sector, for example, you make money twice a year or once a year, you have to structure your payments that way. So those are the clauses. You have to look out, how am I supposed to pay this money back so that it suits you as a business. And of course, look at your clauses. Have they built in punitive clauses when it comes to whether they're involved in the management of your business? Because they can build it in such a way that they will be influencing decisions in your business, and it may curtail the way you do business. So you have to be really careful with these agreements.
Okay. And finally, how do you determine whether to take debt or to get in an investor?
Okay. So how do you determine whether you're able to get debt or a different type of investor, not like, for example, a financier who will be given shareholding?
Yes.
Okay. So okay, there are so many out there, you can't even exhaust them, but let's look at maybe a few. What kind of entrepreneur are you? Do you want to run your business in such a way that you have control of this business? Or do you not mind getting someone to be able to share, who have shared the ownership? If not, then you better get debt financing, because if you get a shareholder, even if they are a minority shareholder, they are going to be involved to some extent in decision making. Okay, and then at the end of the day, at the exit, when you exit this agreement, do you want the person to retain ownership, or you want to finish up with them and say, okay, I'm done with that person, and now on to the next financier? If so, then you want debt financing. But in some cases, you look at debt financing and see debt financing sometimes can be pretty expensive, because you're looking at prevailing interest rates in some cases. Interest rates high, because if interest rates are high, then it means that the amount of repayments that you're doing every month are high, and they are not fixed on whether you make profit or not. So if you have a debt agreement, they don't care whether or not you made money. You have to pay back that debt. Yeah. So if you're the kind of business that is making money anyway, then you don't mind a debt, then you can go ahead and go that direction.
Okay. Thank you very much.
You're most welcome.